I'm going to introduce you to our work on a sustainable financial system to set the scene for our plenary discussion. PRI's mission calls for signatories to support the development of a sustainable financial system, one that supports long-term value creation and benefits the environment and society as a whole. Those words are in our mission statement. The mission states that we will do this through the implementation of the principles. Of course, we've been doing this for a decade. And by addressing obstacles to a sustainable financial system that lie within market practices, structures, and regulation. The mission says these things because we know that the operation of a sustainable financial system can affect the performance of investors. And, importantly, because the financial system is interdependent with the society that it serves. Although PRI has worked on system issues in the past, for example, on sustainable stock exchanges, and recently our work on improving regulation around fiduciary duty, many signatories felt it was time to take a more structured approach to our work. And so we researched the leading work on the financial system, on systemic risk, and the role of investment. We established a group of previous PRI board members, the PRI Policy Committee, and our UN partners, UN Global Compact and UNEP FI, all to support the PRI board in the preparation of our approach. And importantly, we established a framework for our work, built on a definition of a sustainable financial system and to inform the parts of the system that we could influence. This preparation came together in the recent consultation document, Sustainable Financial System Principles Impact, which many of you have commented on, and we thank you for that input. In a moment, our panel will discuss aspects of our work to inform and possibly even excite about the work we have ahead of us. And in doing so, improve our understanding of how investors can work towards a more sustainable system. But first, I'll take a couple of moments to replay to you what you said to us in our consultation and a little more information on what we're hoping to achieve. And this is the moment where the slide clicker clicks to the next slide. There we go. Okay. This is our plan on one page. You can see the words of the mission that I just mentioned. Our objective is to identify 5 projects or so that we can include in the Responsible Investment Blueprint that will be released early in 2017. And in doing so, we'll work towards a financial system that is resilient and supports sustainable, equitable economies. In our consultation, you said that we should include beneficiaries of the system, including savers and insurance policy holders, asset owners, investment managers, advisors and service providers, companies and issuers, stock exchanges, and regulated authorities in our work. You also said we should consider macroprudential authorities and the banking sector. And specifically, some of you said to ensure we include financial advisors on investment products. And so you can see that 80% of you agreed with the scope that we established, and we've noted the additions that you have provided. We presented a list of over 30 risks and challenges. It was a long list. We appreciate that. But you gave us your thoughts, and again, you agreed that we were heading in the right direction. You can see again 80%. In a moment, I'll tell you how we're reducing that list to improve the focus of our work. And you agreed that we should be mindful of what could change the system from the outside. The drivers of change to the system. Things like demographic change, structural changes in the design of pension systems, the growth of emerging markets, technology shifts. Importantly, you said trust was one of the issues we should consider as a driver of change in the way the system works. We took your responses to these 3 questions of a broad endorsement of the direction we're taking, and so we aim to continue now to serve you on these projects and this endeavour. So, what did we do with the 30 conditions? As we said we would in the consultation document, we prioritised them based on which we thought would be most important to achieve a more sustainable system. And our panel in a moment will draw on these 9 issues as they outline their thoughts about how we move forward. These issues will not be new to you, but some of them need another look. It's now my pleasure to introduce Christopher Langner, a capital markets columnist for Bloomberg Gadfly, to chair this session and introduce our panel. Thank you.
I'm going to sit in the middle. Nathan, you all know. We have Nick Robbins from the UN Environment Program. We have Georg Kell from Arabesque Partners, but also one of the founders of the Global Compact. And we have Vicki Bakhshi from BMO Global Asset Management. She's the head of governance and sustainable investing, correct? I'd like to start, maybe I start with you, Nick. Just, you could tell us a little bit about the inquiry. You're the co-director of the UNEP inquiry. You guys have a grand plan for 2020. Could you just outline what's in the UN's mind right now?
Well, thank you. It's great to be here. I mean, I think this renewed focus on the system by PRIs is really to be welcomed, going back to that original mission. So, as you know, UNEP has been working on finance for many years through the Finance Initiative, and 2 or 3 years ago set up the inquiry into the design of a sustainable financial system, which must be the longest tongue-twisting title that ever came up. But essentially, we were trying to say, what is it that we need to do within the financial system to make sure the financial system is doing its job of serving the long-term needs of society and economy, essentially sustainable development. We were looking at investors, at banks, insurance companies, and our focus was particularly on the rule makers. What's the role of the central banks and financial regulators and so on? What we found was this quiet revolution of increasing numbers of rule makers realizing that they had a role in thinking about sustainability. We had Marjun yesterday outlining his strategy, which China has adopted in terms of greening their financial system. So there is this momentum, and I'll go on to touch on what we've been doing in the last year as I close. So firstly, I think this question of building a sustainable financial system is now increasingly on the agenda of policymakers. The role of institutional investors is absolutely key, because obviously institutional investors are part of the system, they're users of the system, and they're shapers of the system. We've been delighted to work with Nathan and the PRI team on the fiduciary duty project, on the rationale for policy engagement. And I really like the 9 issues you've outlined. For me, I'm a simple person, so I boil them down to 3. And I think they're quite interesting. Firstly, is there were things that pointed to broad issues of financial culture, which are not just linked to investors. So this question of short-termism, financialization, incentives, and capabilities. Then there was these particular issues about the investment chain. So questions about the influence of intermediaries, the principal agent problem, the lack of attention to beneficiaries. And then finally, essentially policy. What is it that policymakers do? Maybe they're not paying enough attention to ESG, maybe they're captured by vested interests. What I found really interesting about this list is they're going to some of the fundamental functioning of the financial system. And I think these are issues which still are not being well addressed in the system. So I think it's a great list, and I look forward to your final set of 5. In terms of the inquiry, what we've been doing in the last year is working with countries on their strategies, working with the UK and its Green Finance Initiative, with China, and also at the G20 level, and that's what you heard about yesterday. We'll be working with a whole series of insurance regulators who will be coming together in a new forum to think about their role in sustainable development, very relevant for many of the companies here. In terms of our sort of focus areas that we've been thinking on, again, what does all this mean at the national level? Can we start thinking about how national plans for financial sector development come together with sustainable development? What's the role of Fintech? What's the role of technological disruption in this? How does that shaping our aspirations for sustainable development? This question of capabilities, which is in your list, both skills of professionals like ourselves, but also financial literacy of consumers, And finally, this question of methods and tools and definitions. We'll be launching our one-year update report on October the 3rd, so I look forward to your feedback and reactions on that.
I think that's fantastic, actually. That's a perfect segue because I was just having a conversation with a couple of investors in the previous breakout session, and one of the things that came up, and it's probably something that you can approach, Vicki, is the fact that there is a lot of focus put on investors on how they should require sustainable practices from companies, and perhaps not enough focus put on especially local regulators and the consumers of the products and the big companies that may be able to influence the smaller companies, which are probably sometimes the worst culprits of not following ESG guidelines. So as an investor, how do you feel that the rest of society could contribute better to this, especially regulators, to this discussion and this development?
Sure. I mean, there's a nexus here, isn't there? I mean, the UNEP report is brilliant at setting out that system, but fundamentally you can boil it down to governments and regulators on one hand, companies and investors, and the questions are about, well, how does that nexus work together? How do the points of that triangle interact, and how do we get them working better together? And I think for us as investors, we have to think, well, what do we have the power to do? What's within our power? And how much do we need to be influencing regulators and policymakers and the companies that we invest in? And I think that the challenge with this agenda is that it's so big and broad and sweeping, as the UNEP report brilliantly pointed out. We have to identify what are the pressure points that we can pick as investors, what are the things where we have power, and what are the things where regulators need to enable. And I think the most effective interventions have been ones where each of those three actors have come together, and then you get some change, you get some powerful change. And I'll maybe give an example of that. One of the most exciting developments in Asia at the moment is the development of stewardship codes, and that's something that sort of drew on some of the experience of the UK stewardship code, but put a local slant on that. And thinking about, well, why did those stewardship codes come about? It was not because of the PRI, it was because it sort of came out of government's frustration about that chain not working, about the fact that shareholders weren't having proper control over their companies, which was one of the contributing factors to the financial crisis, and the hope of governments, which was put forward brilliantly in the K review, and then in Japan in the Ito review, was, well, can these stewardship codes actually help be a method of closing that gap? And I think it's very exciting that regulators here have put those codes in place. But regulators can only do so much. They only have so many tools, and really it's up to us to take responsibilities as investors about how to implement those, and implement them well, and implement them in a way that are not tick box, but is actually going to achieve change and change the nature of the relationship between investors and the companies that they invest in. So yes, I think investors have a role in influencing regulators, in taking good examples from around the world and to work with their own national regulators to say, can we have this here? But it's also about investors implementing those, and us challenging ourselves to do that well, and to pick examples of good practice and really push best practice on things like stewardship.
I actually want to come back to that later. I have a personal issue on how investors themselves implement ESG, but that's a whole other story. I wanted to move on, just again picking a segue from what Nick just said, the impact of Fintech on not only on the financial system, but on a sustainable financial system. And I think you're the person to talk about it, Georg, because Arabesque is also, you also do quant trading, right? I wonder, well, quant trading is a computer trading. Aren't computers agnostic to environmental and social issues? How do you balance out the rise of the computer and the investment industry, which they're taking over, with having a more responsible investment industry? Is that even possible?
No, thank you for that question. And allow me first of all to salute the members of PRI and the staff of PRI. When we launched PRI 10 years ago, we had no idea how this movement will grow. When the Global Compact was launched in 2000, only 40 companies started to embrace responsible behavior. Today it's a global movement, Sustainable Stock Exchange Initiative now is taking off, dozens of other initiatives. My point here really is that there's a global movement going on, what you could call a bottom-up movement, voluntary codes of all kinds, looking for new directions, reorienting. I call it Generation S, Generation Sustainability, old and young people, with younger people especially being open for that. And this has been gradually growing. Finance has been lagging behind the real economy in many respects, but it's now catching up. So my sincere congratulations for all of you, and the work that PRI is doing is so fundamentally important. I wish it were to grow further, and your investment, your time spent here is good time spent, and the work that Nathan is doing on sustainable financial systems couldn't be more important. I want to make one point, what I consider the most important angles here from the big picture side. I think on the political side, on the governance side, we have very serious issues. The issue of openness and commitment to multilateral solution finding is being hollowed out. We're actually facing a whole new world order where the old post-World War II regime is no longer really working well, and we have nothing new in place. We're entering into a new space, and this has huge ramifications for investors, for business, because what we have been taken for granted in the past may not be the next framework for the future. I think we all have a vital stake in making openness and rule-based integration work, and therefore the work that UNEP, that PRI is doing in this space is so important. So my first point is really global movement on the way. Secondly, on technology. What has been driving this movement? Clearly, one mega force is, of course, transparency and technology and the ease with which non-traditional issues can now be evaluated and assessed. And the ESG is doing for investors, I claim, what X-ray did for medicine. It allows investors to look deep into what's beyond the flesh and see opportunities and threats in a new way. And this allows investors to take on a much more longer-term perspective. It allows investors to take a fresh look at long-term financial returns and how it's linked to the real economy and to the changing world. Costs of processing information have been declining rapidly. Disclosures of all sorts have been going up. Unstructured data today already offers valuable insights into opportunities and allows redirection of investors. At Arabesque, which by the way stands for the beauty of geometry and math, we process over 100 billion data points every day, and we are convinced, we know already, we brought the empirical evidence that in a portfolio concept, companies which are better on ESG performance, material performance, clearly outperform companies which are not. And this is fundamentally important because it allows investors to accelerate the movement towards more sustainable practices across the board. So technology is a wonderful way of redirecting the landscape on a big scale. The voluntary concept is fundamentally important, making the business case as regulators now step in, and we will hear later about the exchanges, for example. We can see that good practices now redirect activities overall. So I think technology offers the future for that. In the case of Arabesque, we combine a systematic sustainability analysis across all industries with a quant concept. It's rule-based, smart rule-based, it's self-learning, because the insights on combining ESG performance with financial returns is continuously evolving. It's highly sector-specific, it's highly country-specific. So I believe that technology offers a way forward, and as the business case for sustainable practices is becoming stronger, investors historically now have the opportunity to drive change bottom up, not at the expense of returns, but actually with better returns. So I'm quite optimistic on this global Generation S movement, the sustainability movement, responsible investors, responsible companies, responsible consumers moving together, convincing regulators. Hopefully the political systems will not break down. Hopefully politicians will recommit to a rule-based concept, And here, actually, I believe that climate change offers us the opportunity to collaborate again, because climate change cuts across all countries, doesn't respect national boundaries. It is actually the big opportunity to reinvigorate multilateralism. And we have seen it at the G20. There's much disagreement on geostrategy, but there's agreement between the big powers on climate change. Big encouragement.
So basically, you managed to make your computers not agnostic to ESG, and that's fantastic. So maybe what we need is to have all of the quant traders in the world adopt non-ESG agnostic ideas, and then we can have a little bit more balance in terms of sustainability for the financial system.
Well, allow me to add this Generation S. There's a huge infrastructure, the work that you're doing as a data provider. It's happening on a very big scale now, and it all feeds together. It basically establishes what I would call the business case for sound long-term investment. So I think PRI is on the right track on that, but we also need to find ways to communicate to policymakers and to people in general that the contribution of this concept is actually beneficial. It not just helps a few to get richer at the expense of others. We have to rebuild the case for openness in Western democracies. We have a huge agenda ahead on that.
I want to pick on that point, actually, because I know that when we focus on ESG, we focus a lot on the E of the ESG, and perhaps one of my biggest concerns now is the S of the ESG. I've been reading a lot about it, and since 1973, even though average income in the US has gone up, median income has not, which means that people who make a lot of money are making ever more money, and the people who don't make a lot of money aren't. And productivity keeps on the rise, and this generates things like Brexit and Donald Trump and all these fun outcomes that we're seeing in the world. When it comes to that, and I'm going to go back here. Mm-hmm. What can the financial system do to ensure equitability? It's one of the 9 points because how do you balance out, first of all, environmental and social issues in countries like Indonesia, where palm oil is an important way of living for people, mm-hmm. but it also produces the haze in Singapore. And at the same time, how do you get the investment community and banks involved and ensure that there is better distribution of wealth? I mean, I'm probably going too high.
I think we all need to go even higher. I think it's a big issue. I think one of the things that we've learned from the work, for example, of Thomas Philippon, is to focus on the efficiency of the financial system. The financial system is a service function, and we want it to be as efficient as possible. The data, however, suggests that actually the financial system has not grown more efficient over the last 100 years. Generally, with the addition of more technology and more complexity, we get lower cost and more safety. Think about modern aeroplanes. More complexity, more technology, greater safety, and lower cost. Financial system doesn't appear to work like that. So actually, this is one of the things where the technology driver is very interesting. It can be a particularly forceful driver for increased efficiency, better connectivity between savers and their investments and so on, but also some of those benefits could be captured within the system. So I think is there a way in which the financial system works which can contribute to more equitable outcomes, and then obviously is the way in which capital is deployed that can contribute to more equitable outcomes in terms of ensuring that investments respect human rights and so on and so forth. So that's where I think in the moment technology has huge potential, but it's not always going to lead to a more efficient outcomes unless we make sure that actually those rents aren't extracted, as you identified in your 9 points, Nathan.
Well, it's interesting you say that efficiency has a reason or a purpose. We haven't made it safer. You said we haven't made it safer or lower cost in its function, and that clearly is a problem. We've very deliberately set out in this work to focus on a system that serves society. So there needs to be some reason for the work that we're doing, essentially. And without that sense of direction, it's very hard to achieve the ends you've just outlined, despite the fact that every other industry, well, let's not say every, but many other industries in society seem to have that as a part of their role. And so it's important that we bring that back into our work, and that is essentially what we're trying to do.
From an investor perspective, I mean, one of the problems, BMO being a Canadian institution, Canada and Japan now has more 100-year-old people than it's ever had, or anywhere in the world. How do you deal with the demographic change, which is one of the issues pointed out by PRI as well, and to ensure that the financial system is sustainable so that you keep it long term, and at the same time, you're meeting the short-term needs? What do you do from an investor perspective, not just from the technological standpoint?
Yeah, I mean, this whole long-term, short-term debate goes back, we were talking about this earlier, as long as the financial system does. And I think, when you talk about demographic change in younger generations, there is less patience now with that than there was before. And I think that's a certain disconnect and frustration that the financial system is not delivering, and it continues to have the perception of being too short-term. I think you have to start, I mean, you've sort of gone up here, and I think you need to start coming down. I'm going to go down a little bit into how do we actually get the change? Because we all know we want to be longer term. We all know the system doesn't work as it should, and it's not delivering for people now who are going to be retiring in 30, 40, 50 years' time. And I think what you kind of just have to do the slog work of identifying what the market failures are, which is work that PRI is doing, what UNEP is doing, and then picking them off one by one, which we've got somewhere with climate change, is where the Stern Review is coming. It's let's stop worrying about that. Let's bring it down to the individual market failures and pick them off and see what we can do. And I'll tell a story about one example of how those different players can act together to make that happen. And it's this perennial question about quarterly reporting. So we all know quarterly company reporting a lot of it's noise. There's noise, there's churn, but every investor has to look at it, and a hell of a lot of time is spent by the fund managers looking at the quarterly results, and that's time that could be spent otherwise looking at the longer term picture. And we all know this, and we've all talked about this, and we've all kind of torn our hair out. Post-financial crisis in the UK, the K review said this is damaging the productivity of the economy. It's reinforcing that short term is the way that we should be thinking. European directive came out 2013. British government in 2014 says, right, companies, you don't have to report quarterly anymore. End of mandatory quarterly reporting in the UK. What happened after that? 2 companies that I'm aware of, 2 large companies stopped, Unilever and Legal & General. The rest, too scared of what investors would think to stop the churn of quarterly reporting. So nothing really changed. And this is where we come in as investors, because if you're going to do something like that, which is really breaking a kind of fundamental tenet of just how the system works, you have to be a bit brave about it. Someone's got to kind of put their head above the parapet. And what's happening now in the UK is the trade body for UK fund managers has just put a report out saying, we expect companies to drop quarterly reporting. We do not want companies to do quarterly reporting, and if you carry on doing it, you have to explain why you're doing it. So trying to flip the whole thing on its head and make it as clear as we possibly can. This isn't helping anyone. Why quarterly? Why every 3 months? What's so good about that? And also the same report saying, and this is what we expect to see in the narrative long-term strategic reporting. So that's where the government's acted, the government did what it enabled, companies are kind of not really sure, and investors like us, we have to say what we want, otherwise companies won't shift. And so that, I think, is quite exciting. If that worked, I would love to see that happening elsewhere.
But at the same time, investors themselves face that with the daily net asset value for many funds. And how you keep your daily net asset value if you're focused on the long term, if you have a 100-year prospect like the GPIF in Japan, but you have to go to report every year. So how do you balance that out? Any idea, Georg?
Yeah, I think the field of ESG disclosure is progressing rapidly in many countries at different paces, but tens of thousands of corporates already disclose important information. Integrated reporting is clearly the thing to come, where the deep material implications of links to financial returns is better articulated. Investors should pay more attention to that, which they do. I think for investors, the key is to to really show that sustainable good investment is not at the expense of performance, but actually is an enhancer of performance. And by doing so, actually, one can also convince then the corporate world automatically that their good practices are actually being rewarded and not punished. And that will drive fundamentally, strategically, investment decisions in the real economy. And it will shift towards more green investment, towards more inclusive practices, towards more human resource-based, knowledge-based activities, and so forth. So I think we really are on the right track in principle with a deep promotion of ESG integration, but there's still a long way to go to translate the information into viable investment decisions. And there, I believe, the big numbers help, because it is almost impossible at the corporate level to establish a causality between, say, sustainable, responsible investment on the one hand and financial returns on the other, whether on a quarterly or annual basis. Success and failure has many, many reasons. But in a portfolio concept, if you use best-in-class concepts and similar approaches on a large quantitative basis, on average, it is increasingly true by the law of big numbers. So here is a systemic change from within possible, and if investors and business can actually show that good practices, green investment is associated with good performance, then we can change markets from within, we can build more confidence, we can also convince politicians that an open, rule-based, performance-oriented approach is the way for the future. So I see primarily the systemic change that is happening slowly, gradually, as being the big game changer over time. And there are many, many side agendas to it. Just the data infrastructure behind ESG is enormous. There are 120 rating organizations offering 500 rating products. It's very confusing for many. There's lots of unstructured, incoherent, inconsistent information, but increasingly this information is being cleverly, through smart rules, analyzed. So I believe the case is being made increasingly from within. And it's a very positive development, would not be possible without technology, would not be possible without a good incentive structure that is clearly performance-oriented.
So basically, it is possible to invest in the short term with a mind for the long term with the help of technology.
We actually claim, and I may be abusing my position, my role here now, but we know that 40% of our alpha is associated with information that you can already read out of ESG information.
Okay, that's interesting. I'm going to shift a little bit just because I think this is something where the UNEP can collaborate. I noticed that a lot of the discussion on ESG issues happens at a very high level and at a very international level, whereas most of the problems are on a very local level and can usually be sorted out on a very local level. So it requires the involvement of local officials, local non-government organizations, local financial institutions. Often the banks are the ones more involved than the local investors, but then local pension funds as well. How to engage the local communities and the local groups, interest groups, in this conversation and make them align with the longer term view that benefits everyone, not just a couple of people in the local community?
No, I think it's a very, very good point, and I think the example Vicki gave is that financial cultures around the world share many characteristics. We have international standards and rules, FSB, Basel, and so on, but things are often very determined at the national level in terms of culture and practice. I think what we're seeing, and I think this is a real opportunity for the investor community to get involved in, is increasing numbers of countries saying we would like to actually have a strategic view of how our financial system works, and we'd like to set out a roadmap. Indonesia, interestingly, after the financial crisis, realized actually that they were very vulnerable to shocks, not necessarily generated from their own financial system, and have set out a sustainable finance roadmap for 10 years, mostly focused on banks. And one of the first expression of that is a number of banks, I think about eight different banks, signing up to work through a process to better manage lending and practices to the palm oil sector. So really quite strategic. It was both about delivering on sustainable development, but also making a more competitive financial sector. Those two things, financial success and sustainable development. You have in Italy now a national dialogue on sustainable finance. Again, what do these issues mean in the Italian context? Again, very, very special conditions, special financial culture. The UK, a green finance initiative. Again, I think this is perhaps the next stage, thinking about these sort of national processes, systems, which can bring in, and I think what we've seen from the G20 process is that the policymakers really want the expertise and insights from the private sector. That was one of the real things, I think, that make the G20 work, and PRI was one of the knowledge partners. So I think there's an open invitation now at the national level, but also at the international level, to think about where we can bring together market leadership and policy frameworks.
Yeah, I was just going to say I'd agree with that. And if you look at the fiduciary duty work we did,
Right.
we're now branching 14 different countries, each with their own roadmap, which includes an assessment or an understanding and some plan on what needs to happen in that particular market. Now, the principle is the same. We want to work on investor duties and the interpretation of those. But we realise each of those 14 countries have some nuance and some difference in their approach. And so if we're going to be effective in these countries, we need to tailor, we need local relationships and context. So we are starting to get ready to do that work.
And how can global investors like yourselves, who may have some more clout in terms of assets under management, for instance, influence this conversation to go local and to be followed locally? Have you tried to have that conversation? I know that you've done it on a local basis in the UK. Have you approached policymakers elsewhere or companies from your portfolio that might be able to approach policymakers? How can the asset management industry contribute to that conversation?
I think one of the challenges here is well, it's a couple of challenges in the interaction between investors on the one hand and regulators on the governments on the other hand. Clearly there's a challenge with resources, so we do put time into public policy, but it's kind of not the day job. It's something we do because we think it's right, but it's time consuming if you're going to do it well. So then you can solve that through things like collaborative bodies, like the Institutional Investor Group on Climate Change, where you come together to engage with regulators as a group, which is better for the regulator or the government because they hear a single voice. They get horribly confused if they hear different voices. I think the other challenge in having worked on the other side of it in government is especially when you get to try to influence at the high level of government, it's just a lack of understanding of how investment works. I mean, I worked in the UK Finance Department, the Treasury. Didn't really know, it was kind of, the city was kind of there, but we didn't really know how it worked and how the pieces fitted together. So some of what you have to do if you're actually going to effectively influence at the governmental level, not talking about regulators now, but the governmental level, is just do this kind of basic, this is how we work, explaining where we sit in the investment chain. And also I think getting across and just repeating the simple messages. So on climate change, a simple message was, if you tackle climate change, it's in our long-term interest as investors. And we just kept on and on and on repeating that message, and it does get through. And then with the regulators, you're talking a more detailed level of engagement where you're really getting down into the detail of the regulations itself. So it can work, but it takes time. It's challenging. And we also engage with companies, of course, partly with them, it's been to remove the negative lobbying, because there's always lobbying, counter lobbying. So on climate change, some of the engagement we did with companies was to say, do you really think you should be financing these climate skeptic groups? Is this really what you want to do strategically? And a lot of that funding's now been pulled back as a result of that investor engagement.
But which is, part of the global compact.
Yes, I would even go a step further, and I fully concur. We face a fundamental dilemma. Markets have gone global. Business and investors remain local. It's the other way around. Politics is local. Markets have gone global. Politics is local. This disconnect, unfortunately, is now getting stronger again, with nationalism on the rise, with multilateralism being weakened. And this is a systemic big threat to the foundation of prosperity. I think it is fundamentally important that investors raise their voice now in the national context, but also at the global context. And one way of expressing your voice and your preferences is strongly engaging also in global institutions. PRI is becoming the voice of sustainable investment, and it's very important that this voice is being heard, that it's being articulated, that it is being communicated to relevant policy bodies, the G20 and others, but also feeding back to national legislation and national voices and supporting these bottom-up processes, this Generation S movement, which is now a global movement, and I believe irreversible, because technology itself is irreversible. So fundamentally important. I think the stakes couldn't be higher. I have to say with regret that for the first time in the many years I've been involved in global affairs, I see markets becoming an instrument of power. There used to be the great golden decades of the 90s and the last 3 decades, where there was a consensus that market efficiency drives prosperity. Therefore, politics is about creating an enabling environment that allows fair, rule-based competition to spread worldwide. Now there's the temptation in many quarters of the world to actually make markets an instrument of other geostrategic concerns. Investors should raise their voice. It's prosperity that is at stake. And after all, greening the world requires huge amounts of finance. And we want to direct finance to the needs of the people long term, and realigning finance investment with sustainable development. Don't forget the United Nations. Invest in the United Nations, the Sustainable Development Goals. Invest in the structures that hold countries together. The ASEAN region is a great, great place with lots of future, because that's where the spirit of economic, political integration is very much alive and very fertile soil. So I think investors have a bigger stake here, and these voices must come out now. You must speak up, you must collaborate, and PRI is a great place for making that happen.
We don't have a lot of time, so I'd like to get a sense from each one of you. You included, Nathan, please. The whole concept of a sustainable financial system is quite wide. I view it as something that involves the banks, involves the investors, the insurance companies, and regulators as well. What do you think are the threats? We all have talked about the opportunities of a sustainable financial system, right? I want to do some fear mongering. What are the real threats to a sustainable financial system? I think you pointed out a very good one, Georg, the rise of nationalism and how that plays out in the views of environmentalism and even equitable societies across the world. But from each one of you, what do you see as the biggest threat right now to a sustainable financial system, and how to address it, please? Who wants to start?
I'm happy to lead off. So I think one of the biggest threats is the relationship we have with our beneficiaries, and whether or not they continue to think that we're serving their interests. At the moment, they're not quite sure sometimes, because they may not be quite that engaged. But I think if we've learned anything from the last few years around the rise of social media and peer-to-peer relationships and networks, is that they'll start to form their own view anyway. And so we've still got a bit of a void, a gap in our relationship with our beneficiaries. And if they start to doubt whether we're serving their longer-term interests, then that relationship of trust is going to be very difficult to rebuild. So I think that's one of the major issues we face.
And I would say the linkage between the financial system and the incentives it has and the underlying productivity of our economies, and therefore the growth potential of our economies. And then this continuing evergreen issue of time horizon. And I think that we continue to talk about it, but I don't think have got really good ways of both making sure that we drive out irrational short-termism, but also do align the financial system to the longer-term needs of sustainable development. So I've got two.
I think I come back to the question of resource, and I think in this industry, for very good reason, there's pressure on fees, pressure for more transparency on fees, for fees to come down. At the same time, if you're really going to crack this problem, and I do believe it's part of our duty to do this, and if you're really going to do things like stewardship in a good quality way, the way that the K review set out, the way the Ito review set out in Japan, in a meaningful way, it can't be done for free. And I think those two pressures are coming to are real. And I think it's, we all want this, but I think it does take time to do, and I think that resource pressure is a very real one, and this is where obviously institutions like the PRI come in to help to fix that. I wouldn't underestimate it.
I think the slowness of in the investment community in realigning with the real needs and recognizing in time the changing signposts from climate change to social exclusion. And that's where ESG integration is an important part of the answer.
I'd like to open to the audience to make any questions. Did I miss anything?
Oh, there's one there.
Sorry. Later if you can, over here.
Julian Poulter from AODP. Just like to thank Nathan for mentioning the word beneficiary there. And Nick mentioned that finance has got a problem generally with serving its customer base. We don't even call them customers, we call them members and beneficiaries. Going to Vicki's point about drilling further down, don't we need to start building in processes that better serve the, 300 to 400 million beneficiaries there are in the world, and get them more involved? Because the most recent litmus test of how we do that, which was the Exxon AGM vote, saw 1,000 funds contacted by their members, and less than 3% of those funds actually responded within the time of the AGM. So whilst we talk about these amorphous concepts at the very high level around sustainable finance, there are some really quite simple things that we can do to actually be more accountable to the beneficiaries, isn't there? Isn't that the priority, to get those people involved and try to explain to them what we're doing? Because let's face it, most beneficiaries don't even understand the concept of a portfolio.
Anybody want to tackle that one? That
Yeah,
sounds like
no,
one for you, Vicki.
I think getting beneficiaries connected with their investments and their pensions is a big issue. It's a big problem. People do not know, like you say, what a portfolio is. People, if you ask a lot of people, they wouldn't necessarily know who manages their pension. And I think this area that we all work on is a great opportunity to actually bring some meaning to their investments and connect people with what they're investing in. If we tell some of the stories of what we do on engagement with companies, on responsible investment, these are things that people can understand.
Right.
That we talk to companies about the corporate governance, that we talk about labour standards. Most people don't know that. So I think the whole responsible investment agenda could still be so much better communicated, because there are stories that actually relate what I own in my pension to what matters to me as a human being.
Since it's so important, maybe just a second element to that question. I think there are people of goodwill in this community who have been trying very hard for a long time to build deep relationships with their beneficiaries. You know who you are. We've been trying to do it. It hasn't worked that well in all cases, but it is true, to emphasise the point Vicki's making. We now have an opportunity to talk about the issues that beneficiaries care about as the first port of call, and then link that to investment, rather than trying to explain investment to them, which is perhaps not what they're so interested in. But they are interested in whether or not their local environment is clean. They are interested in whether or not they send their schools and they live in their kids to good schools and live in safe communities. If we can find a way to talk about the issues they care about and then describe how investment affects those, we have a basis for a much more substantial conversation. And that's the conversation they're having now that we can tap into.
Right, and may I just add here, again, technology can be the key to the solution, because the future of sustainable investment clearly is being transparent, and people want to know where you invest in, and this can be achieved with technology, and it plays a key role here to give money eyes, so to speak, and create a whole new awareness and a whole new feeling that sustainable investment actually is not only associated with good returns, but also is a positive force in how it's at work.
Yeah.
And that is a key probably to communicate effectively the solution part.
And I would add maybe just, with technology, there's really no excuse for that transparency. We have the Montreal Carbon Pledge. Right. Are all beneficiaries of the signatories of that, $10 trillion or more? Do they know about that, or do they know about the great work the institutions are doing? And then the second point is involvement. Are there ways whereby technology can enable that involvement, not just the transparency? So I think we've got great tools at our disposal.
Sorry, there was a question over here. In the meantime, while she runs over there.
Sorry, Jürgen Hammer from Grameen Credit Agricole Foundation and the Social Performance Task Force. A question to Georg from Arabesque. You said that technology allows Arabesque to provide evidence about the fact that ESG integration provides long-term financial benefits, etc. I think this is the vital question of our debates. Yes. In the impact field, we are fighting with exactly that question for years. Yes. And I think more than technology, it is stable, clearly identified data. I would like to know what you do on the ESG side to use that stable data to provide that kind of evidence.
Well, you're welcome to check on our website on the process. Part of it is proprietary, but I share your enthusiasm. Having been advocating responsible business practices for much of my life, many CEOs around the world understand intuitively that good responsible practices over time are associated with good superior financial returns. It's also an insurance policy against crisis situation and builds resilience. But to bring the evidence in numerical and empirical terms has been enormously difficult. And in a study which PRI is well aware of and has helped us to distribute, we did with Oxford University a meta-study analyzing into all correlations that existed before. The evidence is overwhelmingly clear that companies which outperform on material ESG performance also outperform their peers on financial returns and stock valuation. It's a fundamental breakthrough, I would argue, because it establishes de facto the business case for sustainable investment. That is a fundamental development, fairly new, and it's only possible to establish this evidence now because of big numbers. It was not possible to bring this evidence 2 years ago. The good news is also the numbers and the quality of numbers is improving almost on a daily basis. The stock exchanges are now encouraging companies to disclose more. Many frameworks, voluntary concepts are driving this movement. So the input quality is being enhanced. My colleagues in research tell me that at this point they can unlock only 10% of the ESG value, this X-ray capacity to look into relevant risks and opportunities associated with sustainable performance. But over time, these 10% will grow. And in a not too distant future, we will actually see much, much more and much, much deeper. So I believe, again, technology and big numbers help us to drive performance, and it also helps to redirect investment towards solutions, which allows us to communicate in a transparent way the positive contribution that investment is making to bigger challenges.
How about the investment companies themselves? They are not very good at disclosing their own practices. There was a story on the FT maybe a month ago, showing that out of the 10 biggest investment managers in the world, only 6 of them reported ESG. Yep. Don't we all have to be the role models in the first place?
Of course. The company which I had the privilege to join is a very young one. We are a startup, 30 people. We support the Global Compact. We support PRI. We think it's fundamentally important to disclose, and it's fundamentally important also to invest in these collaborative efforts, because for all the good reasons we outlined, it is now time really to safeguard what I would call the foundation of prosperity for all.
That disclosure is also important in terms of that functional investment chain. So we, in our EMEA business, we have for many years published not only how we vote, but why we vote, how we vote at company AGMs, because we think that's an important part of that stewardship, that ownership relationship between us as shareholders and the companies that we invest in, to say, well, if we're gonna take the time to look at your AGM, if we're gonna take the time to vote, we want to tell you why, because you need to know so that you can then look at that, look at what your other shareholders think, and make decisions accordingly. So disclosure is not only important because we are accountable and we should be accountable, it's also important as a communication tool and as part of, as I said earlier, the growth of stewardship globally. That's the kind of thing that we would like to see more broadly, is that type of disclosure and communication between investors and companies.
One last question, I'm sorry. Over there. Okay, well, two quick ones. Sorry.
Michael Salvatico from MSCI ESG Research. We've talked a lot about changing things. We're changing short-termism to long-termism, changing disclosure. What I don't hear is the change that brings what we're talking about here, the change to link this to the investment community directly. In terms of changing the way we report on the performance of funds, without focusing just on financial return, if sustainable investing is going to be successful, there need to be other metrics that investors look at and measure their fund's performance on. For instance, there's one asset owner that I know of who does this quite well, LGS Super in Australia, who publish not just their carbon footprints, but their ESG exposures. So using an ESG rating as a measure, for instance, of a strategy or a manager or your overall fund's impact in sustainable investing. And until we get these kinds of measures, it's going to be challenging to lead traditional investors along the curve. What are some measures that you can think of that might encourage this movement, this change in sustainable investing?
Nathan?
Yeah, thanks. Let me see, top of my head. I think that we should look at the quarterly reporting question. And so the obvious question would be, what's a better horizon that we should have our financial numbers reported and shared and rated? So there's one that's very close to home that we should be working on. And PRI, as arguably the best place in the global investment community for which to agree and disseminate new practice on this issue, there is clearly a role for us in this question. So there's one. People may have others.
Do you see any measures of ESG that should we aggregate measures of ESG to performance as a way to inform the beneficiaries? That's more or less what I understand of the question.
I think it happens already in many, many ways. It's this bottom-up movement. Many actors, information providers, service providers play a fundamental role. Stock exchanges, and we will hear later about the enormous progress that is happening in that space. Regulators, industry, sector-specific initiatives, of which there are many, many more coming and now becoming active in this space. So I think the field is virtually highly dynamic. It is growing. And it's to be encouraged full force.
Vicki, any thoughts?
Yeah, we've got sessions later here today on impact reporting. Clearly that's got to be part of the solution here. Let's report on things people care about. It's not just performance, but it's impact. And then there's performance against what, which gets you into the whole question of benchmarks, which we probably haven't got time to talk about now, but that's clearly one of the key questions is when you have a benchmark, performing against that benchmark, is that really what people care about, or is it more absolute returns?
And I think probably the key thing is to try and report things that are quantifiable and easily understood rather than just process. There's obviously lots of process, but actually that's why I think the carbon footprint, as simple as it may be, is a very useful technique and helps close the circle. I can give an extra driver for corporates to report, that they see that their owners and investors are also reporting. That leads to that reciprocity and I think drives the overall system forwards.
We're out of time, but and because I like to be equitable, and that's one of the 9 points. Somebody else was raising their hand, trying to ask a question. Yeah, very quick, if you don't mind.
Hi,
because everybody wants coffee.
It's Chris Fox from Ceres Investor Network on climate risk, and investors in the room have been collaborating on engaging with the G20. And I wanted to ask Nick, given your expertise on that topic. The G20 meeting is next year, July, I believe, in Hamburg. If you could write the dream headline of what would come out of the G20, what would that be? What would you like to see in terms of the desired outcome for July 2017 from the G20?
There'll be many, many things, but maybe particularly for this community is you could imagine a joint program between investors and the G20 to really build the capacity that's needed for the investments for both a green economy and for the implementation of the climate agreement, particularly given the timelines we have coming out of Paris. But I think there's a real appetite, certainly from the green finance work, for actually joint work with the investor sector. So actually a piece of joint work would be very exciting. There'll be probably 20 other headlines, but that would be one particular one.
Thank you very much. Look, it's time for coffee. I think we all need the caffeine. Thanks again. Appreciate it. Thank you, Nathan. Thank you, Nick.
Thanks so much.
It's a pleasure.